A lot of people might think that the only way to get cash from your stock investments, without selling shares that is to collect dividends. However, covered calls are a powerful option strategy that can be used to generate cash from your shares, whether or not they pay a dividend. This means that you can earn substantial cash every month or potentially even every week, even if your stock holdings pay no dividends whatsoever. So in this video, we're doing a complete overview of the covered call strategy to help you earn cash flow from any stock. We'll start with an explanation of covered call option contracts and how they work. Then we'll dig a little deeper and talk about what impacts the size of the cash premium you'll receive and how you might use these covered calls in your portfolio. We'll also talk about the 3 potential outcomes of covered calls and how you'll be taxed for each of them. Finally, if you're not comfortable with covered calls by the end of this video, or you have a small portfolio, we'll talk about how you can still enjoy the cash flow that this strategy provides. So stay tuned for all of that, as well as how you can get free cash to invest today. Let's get started. To start us off, I want to demystify options a little bit by clarifying that there are really only 2 types of options contracts. These are call options and put options. You can either buy or sell these options contracts depending on your investment goals, making for a total of 4 basic option strategies. I previously covered buying call options, specifically long-term call options known as LEAPs. Today though, we're discussing the opposite, which is selling call options, also known as covered calls. A call option is a time-sensitive contract that gives the holder the right to buy 100 shares of an underlying stock or fund. So if you happen to own a call option for Apple stock, for example, you could act on that contract in a process known as exercising to purchase 100 shares of Apple. But before we can understand why someone might use call options, let's break down a few of their key characteristics. All call options contracts have 3 qualities that you need to be familiar with: an expiration date, a strike price, and a market price. The expiration date is pretty straightforward. This is the date that the contract expires, after which the buyer no longer has the right to purchase 100 shares of the underlying security. The strike price is very important, as it determines what you'll pay to exercise the contract and when it becomes exercisable. You may also hear this called the exercise price. So to continue our Apple example, if you owned an Apple call option with a $150 strike price, you could exercise that call option to purchase 100 shares of Apple at $150 each. In short, the strike price is what you'll pay per share to exercise the contract. This price is important because if the share price of the underlying stock is lower than the strike price, the contract probably won't be exercised. And that's because in this case, it makes more sense to just purchase the shares from the market. However, when the share price is higher than the strike price, the contract will likely be exercised because it makes it possible to purchase those shares at a discount compared to the market. The last quality is the market price, which is what the option contract itself is trading for. Options are traded much like stocks, so the price of the contracts will fluctuate throughout the day and over time. There are 3 main factors that determine the price of options, but we'll dig into them more in a few minutes. So why buy call options? For investors who think the price of a stock will go up, call options are a great way to increase your returns. In doing so, you can buy the option to buy 100 shares, locking in your price per share via the strike price. In the future, if the stock price goes above the strike price, the holder of the call option can use it to purchase shares at a discount. This allows the buyer to benefit from upward price movement in a stock without having to buy 100 shares in full, which in some cases can be pretty expensive. However, this is only one side of the trade. Someone has to create and sell the call option to the buyer, and that's where we get into covered calls. While buying call options secures you the right to buy shares, a covered call is when you sell a call option, giving someone else the right to buy your shares. So instead of paying for the call option contract, you're selling that contract to someone else and collecting cash in the process. This is known as a covered call because the contract is covered or secured by your shares. If the buyer decides to exercise their call option, you'll be forced to sell your 100 shares to them because that's exactly what the contract entails. So before we get any deeper into covered calls, please understand that when you sell a covered call contract, you're placing the future of those 100 shares in the hands of the market and the buyer. I'm going to go over some more specifics right now, but keep in mind that when selling covered calls, there's always a possibility that you're forced to sell your shares in the process. The beauty of selling covered calls, though, is that you decide the exact conditions of your options contract and the scenario in which your shares can be sold. So if there's a time frame or a price point you're willing to sell your shares at, you can build your covered call around that to get the optimal outcome. The first requirement is that you own 100 shares of a stock or ETF that is available for options trading, which should include most securities. Again, this is because each contract gives you the right to buy 100 shares of the underlying security. And since you're selling this right to someone else, you need to have the 100 shares available to hold up your end of the contract. If you don't own 100 shares, don't worry. I'll show you how you can still participate in covered calls later in the video. But once you have 100 shares, you can sell or write a covered call contract. At this point, you can select the expiration date of the contract, the strike price at which your shares will be sold, and the cash premium you want for the contract. The decisions you make for each of these points will primarily depend on how much cash you want to generate from the strategy, the price point at which you're comfortable selling your shares, and your general outlook on the stock price. But perhaps the biggest thing we have to break down is the cash premium, which is the amount of money you'll receive for selling the covered call contract. As I said, there are 3 factors that determine the covered call premium, and these are the price difference between the contract's strike price and the stock's current share price, the amount of time until the contract's expiration, and the volatility of the underlying security. These factors are also known as intrinsic and extrinsic value. Intrinsic value is the value baked into the contract based on the difference between share price and strike price. In other words, it's the guaranteed profit you get from the option contract if you were to exercise it today. So if you had an Apple call option with a $140 strike price, but it's trading at $150 per share, the contract guarantees $10 of profit per share. This means the contract would have about $10 of intrinsic value, and that is going to be included in the option premium. However, with covered calls, you're likely going to be selling call options with a strike price higher than the share price. This means they won't have any intrinsic value, because they don't have any profit baked into the contract. So when selling covered calls, the premium you're looking at will typically just be made up of extrinsic value. Extrinsic value comes from a combination between the stock's volatility and the time until expiration. A more volatile stock will have a higher premium because there's greater potential for price movements in either direction. A contract with a longer expiration date will also have a higher premium because with more time, there's more potential for price movement to occur. Of course, for someone who is selling covered calls, while you will generate more cash for selecting high volatility, long duration contracts, there is a higher probability that the contract will be exercised by the expiration date. So let's put this all together and walk through a real-world example with one of my holdings. I have over 100 shares of STEM stock, so I can sell a covered call on these shares. Since STEM doesn't pay a dividend, this gives me the opportunity to generate cash flow that wouldn't be possible otherwise. If we pull up the option chain, which will obviously look a little different depending on your brokerage, you'll see I've selected to sell a call. First, we see a range of expiration dates that we can sell contracts for, where I've selected September 3rd, which is approximately 1 month away at the time of writing. The main number on display is the strike price of the contract, and next to each strike price, we can also see the current market price for the option. The market price is actually per share, and since each contract represents 100 shares, you'll get 100 times the market price. So with the current share price at $26.73, I might select to sell a call option with a $30 strike price that is paying a $1.73 premium. You can see that the same strike price will earn me less money if I pick an earlier expiration date because it has less extrinsic value, and will earn me more at a later expiration date because it has more extrinsic value. Similarly, the premium increases in value as you get closer to the current share price because the option is closer to offering intrinsic value. If I sold the September 3rd option at a $30 strike price, I would get $173 the instant I sold that contract. But if the price of STEM rose above $30 anytime until September 3rd, the buyer would likely exercise the contract. In this case, I would be forced to sell them 100 shares of STEM at $30 each, even if the price went even higher than that. And that's the risk you take with selling covered calls. On the bright side, I would get to keep that $173 of premium, making my total earnings per share $31.73. On the other hand, if the price doesn't break above $30 by the expiration date, the contract wouldn't get exercised, and I wouldn't have to sell my shares. But I'd still get to keep the cash premium I collected, earning cash from my holdings even though they didn't grow in value or pay out any dividends. Then I could repeat the process and sell another contract to continue earning income. So with all this in mind, I think there's really 3 approaches to selling covered calls for cash flow. The first is that you're not really willing to sell your shares, but you still want to generate some income off of them. In this case, you'd select strike prices that are farther away from the current share price, as well as shorter term expiration dates. This makes it less likely that the stock price will increase enough for the contract to be exercised, and therefore less likely that you'll be forced to sell your shares. Of course, both of these adjustments mean that you'll earn less cash from your holdings. So you might have to explore the options chain to find a happy medium between the cash flow you're happy with and the likelihood of the option being exercised. The second is that you're willing to sell your shares, but you want to secure as much cash as possible. In this scenario, you'd select a strike price much closer to the current share price, and maybe even medium to long-term expiration dates. Both of these choices will drive up the cash premium you receive. Plus, if you can identify a price point you'd be happy selling a stock at in the future, you can select it as the strike price to secure a profit level you're happy with. If the stock hits that point, you get to sell at your desired price point and you've earned cash on top of it. And if it doesn't, you can just repeat the process and continue earning cash until the share price finally increases. Of course, this strategy comes with the chance that the stock moves even higher than the strike price, at which point you miss out on any additional profits because you cap your returns with the covered call. The last scenario is that you're worried the share price will decrease and you want to use covered calls to minimize your losses. Another strategy here is to buy a put, but that's a different option strategy that requires purchasing a contract. With covered calls, you can get some downside protection in the form of cash up front. In this case, you'd likely sell a covered call as close to the strike price as possible, and maybe even below the strike price. This would earn you the highest possible cash premium, which should cushion some of the losses in your portfolio from a drop in stock price. And of course, you wouldn't be forced to sell your shares in this scenario, so whether you cut your losses and sell them on the market or continue to sell new covered calls is up to you. And with that, you should have everything you need to know to sell your first covered call contract. But after you collect that first cash premium, there's two other things to consider. The first is the closing or assignment of your covered call contract, and the second is taxes. When it comes to closing the covered call contract, you may think there are only two outcomes. The first is that the share price reaches the strike price. This means it's profitable for the other party to exercise their contract, and you'll be forced to sell your shares at the strike price. This is typically done automatically by your brokerage, and you'll be notified when it occurs. The second is that the share price doesn't reach the strike price and the contract expires worthless. At this point, nothing happens. You keep your cash premium and your shares. You can even repeat the process with another covered call. But there is a third outcome that you have complete control over, and that's closing out your covered call contract before it expires or it gets exercised. To do this, you simply need to buy a call option with the exact metrics that you sold a call option for. So if I sold a covered call on STEM like we looked at earlier with a $30 strike price and a September 3rd expiration, I would need to buy an identical call option with a $30 strike price and a September 3rd expiration. This cancels out the contract I sold originally, leaving me with no obligation to buy or sell shares. The caveat here is that the premium for that contract may change over time. As the price rises, for example, the contract will get more expensive. So if you see the share price rising and you start getting worried about having to sell your shares, you'll probably lose money trying to buy yourself out of that position. On the other hand, if the price of the stock drops, the price of the premium will too. In this case, you can typically buy yourself out of your position for less than the cash premium you initially received. This way, you can actually keep a few dollars, but eliminate the obligation to sell your shares if things turn around. So now we'll wrap up with taxes. The first thing to understand about covered call taxes is that the cash premium is not technically considered taxable until the call option is closed. As we said, the call option can be closed by expiring worthless, by being exercised, or by you purchasing an offsetting call option. No matter how long you held the call option, or however long its expiration date was, if it expires worthless or you purchase an offsetting option, your cash premium is taxed as income under the short-term capital gains rate. So keep this in mind, as it will be a higher tax rate than the long-term capital gains. However, if the call option gets assigned and you're forced to sell your shares, the taxation of that cash premium will change depending on how long you've held the underlying shares. So if you held the shares for longer than a year, you would get the long-term capital gains tax on the covered call premium and the sale of your shares, while holding for less than a year would subject you to the short-term capital gains rate. Keep in mind that all of this is just for out-of-the-money call options, which again is when you write a contract where the strike price is higher than the current share price. And this is the typical covered call strategy, but things get a little more complicated with in-the-money options, where the strike price is lower than the current share price. I'm still not fully knowledgeable on the practical applications of selling in-the-money call options, so I'm not going to cover those taxes here. But I'll leave a link below to a guide on Fidelity that covers all the details. And now we've reached the point where I think I've finally covered all of the necessary details about covered calls. But there's one thing left to address, and that's how you can use covered calls in your portfolio without owning 100 shares of a stock, because that could require a pretty large investment in some cases. The good news is there are tons of ETFs out there that use covered calls to generate income for investors. These ETFs will purchase all of the shares necessary and then sell covered calls on specific holdings or even their entire portfolio. Then, the cash premium they collect from covered calls gets passed through to investors in the form of monthly dividends. One of the most popular options is QYLD, or Q Yield, which uses covered calls on the Nasdaq 100 index to pay a nearly 12% annual dividend. There's also X Yield, which uses the S&P 500, or R Yield, which uses the Russell 2000. There are some other ETFs that employ more complicated covered call strategies, such as NUSI, JEPI, and DEVO. I've covered a lot of these on my channel already if you want to learn more, and I plan on covering more in the future as they seem to be pretty popular dividend investments. So hopefully this video helps you guys understand the strategies within those ETFs a little bit better, but also to understand the covered call strategy on its own. I do think these ETFs are convenient ways to benefit from covered calls, but if you can use covered calls yourself, you'll you'll have so much more flexibility in how you can earn income from your investments. By the way, if you want to get started with some of these dividend ETFs or passive income investing in general, definitely check out M1 Finance. It is hands down the best investing platform for dividend investors. I've been using it for over a year now, and it's only gotten better and better. There's a link below if you want to learn more, and even get $50 for free when you open and fund an account. So check that out if you're interested. But in any case, thanks for watching, and I'll see you next time.